Good morning. It is Tuesday, the 8th of September, the first day after Labor Day for the business week. I was deciding and had decided to just go ahead and stop. Friday, we ended with a pretty dramatic downturn in just about every market. And I said, Saturday, Sunday, Monday, we'll just leave those alone. There'll be slow new days. It's Labor Day weekend. We'll come back on Tuesday. And today is that day. And we are wanting to see what's up with the market. We definitely had a big correction in tech stocks, and it looks like crypto and possibly precious metals as well. I just want you to know again, I am not shook, okay? We were going up for a long time in all of it. A correction was for sure going to happen, and I'm still incredibly bullish. So with that, let's jump into the news. Bitcoin holds above $10,000, eyes on Wall Street opening. Despite a quick dip below 10K, Bitcoin has recovered and stands above it. According to this, that's not correct, but it's very close. Maybe by the time this was written. So the rest of the market resembled BTC's movements with initial dumps and quick recovery. Given the high correlation, all eyes are now on Wall Street as the market will open today for the first time since Friday, and it's interesting to see how this will impact Bitcoin's price. As reported yesterday, Bitcoin was struggling to remain above 10K. A few hours ago, bears took control and drove it below the coveted mark once more. The asset bottomed at $9,880 and came close to filling the CME gap at $9,600. However, instead of dipping further and closing the gap, BTC reversed and spiked. The primary cryptocurrency reached an intraday high of 10,400, but has retraced slightly to 10,280 now. According to the data analytics resource Sentiment, Bitcoin's network activity displays bullish behavior despite the most recent dip beneath 10K. The company noted that daily active addresses, which sometimes could indicate upcoming price developments, are sustaining nicely. Additionally, Sentiment reported that the BTC transaction volume has been increasing lately, suggesting rising interest around this $10,000 price level. All coins follow Bitcoin as usual. The alternative coin market tends to resemble Bitcoin's larger moves frequently, and yesterday was no exception. Ethereum bottomed at 325, surged to its intraday high above 350, and has retraced to 345. Ripple has dumped in value to 23 cents, pumped back up, and is currently sitting at 24 cents. That seems like a good time to buy. The entire market cap slumped by 15 billion following the daily lows, but it's now hovering at approximately 330 billion. On a 24-hour scale, most of the market is in green. Despite the intraday dips, Chainlink retains its position in the top 5 after a 1% increase. Bitcoin Cash 0.5%, Bitcoin SV 5.2%, Binance Coin 2.4%, and Litecoin 1.3% pump in value from the top 10 coins. Okay. I usually stop reading when they start going over all the coins like that. I've been wondering about this. Is this an actual thing? Yeah, this is a heat map. I've never seen that before. I mean, I've seen screenshots of it, but I've never looked at it live. That's pretty interesting. Okay, well, it doesn't look exactly like this now, does it? That's pretty cool. That's at coin360.com. I'm sure there's other ones too, but that's pretty awesome. Okay, and let's see on Forbes. News that Tuesday tech tumble. Post-holiday blues, a short week starts with a thud. Tech selling resumes after Friday's short recovery as mega caps keep getting hit. Tesla is down double digits after carmaker isn't added to the S&P 500. That's a big deal. Sorry, Tesla. Last week's lows could be tested in coming week with possible support seen at those levels. If you thought last week's tech selling was just the market flinching ahead of the holiday, Tuesday morning feels like an ugly wake-up call. The dip buying mentality from Friday didn't spill over as NASDAQ 100 futures fell about 3% in pre-market trading. Tesla is down double digits ahead of the bell amid disappointment over its not getting added to the S&P 500. These same mega cap stocks that led the selling last week are primed for more declines today. Apple, Microsoft, Alphabet, and Amazon, most of the big year's kahunas. Tesla's not getting added to the S&P 500 might have the big event setting off a lot more of the selling. A lot of people had expected it would be put there, which would possibly have supported it, as many S&P 500 tracking funds would have had to add Tesla to their collections. The Tesla helped lead everyone up, and now maybe it's taking the lead in the other direction. One thing investors shouldn't do is panic. We were up so many days in a row, and now we're not. if you look at where we are right now and want some perspective, the market is back at the levels it was on August 20th. Now, I'm not panicked, guys. I don't think you should be panicked yet either. That being said, you've heard me say before, the stock market's probably the riskiest of all the things right now. Let's drill down to see why the selling might be happening and what it means as fall unofficially begins. Last week's lows might be tested. The market plunged Thursday and then again early Friday before clawing back from its worst levels by the closing bell. That was in low volume trading ahead of the long weekend and appeared to reflect a little buy the dip mentality. It's also typical to see a slow grind higher the afternoon before a 3-day holiday. Volume was light on the way up Friday, which is why you can't always trust a last minute move ahead of a long weekend. A lot of these people still question valuations, especially in the tech space. Those questions don't go away just because of Friday's late recovery, and a big shift in momentum like we just had can take a few days to reverse. With all that in mind, you can make the argument that the lows might have to be tested again sometime in the next week to a week and a half. The question is, how long will it take? Today's early action suggests it might be sooner rather than later. That said, the market has come back quickly from previous stumbles lately, in part because many people tend to see drops as a buying opportunity, particularly for mega cap tech shares. That may eventually be the case, but it's not happening in the early going. Where could this support come in? Last week's lows are one possibility. The comp's low rate last week was down 10,875, about 10% from Wednesday's close and 5% below Thursday's close. Then it rallied back to being less than 1% at one point late Friday before closing off at about 1.3%. That means 10,875 could be the level to watch for possible support on any pullback here, and also represents about the level of a formal correction, which many analysts see as 10% from highs. In the SPX, the Friday low of 33.50 might be interesting to keep an eye on. The SPX tumbled below two key support levels earlier Friday at 3426 and 3393 pretty quickly, and then managed to plow back and close right at 3,426, the low posted overnight between Thursday and Friday. Holding this level could be key to seeing more buying interest come in. The SPX was only down a little over 6% from all-time highs when it reached its low mark last week, so it remains well off correction levels. A correction would bring it all the way down to 3,222, a level it was near late in July. Analysts warn that liquidity has been lately light in general, even before the big sell-off Thursday. This might make the market more prone to big gains and losses like we've been seeing. It's possible that also the action in the fixed economy market this week could help determine some of the direction. Volatility jumped 15% this morning before the bell. There's also a lot of news about how one Japanese conglomerate had been making big bets on tech in the options market. The idea that one major player might have been behind a lot of the run-up could be making people nervous, especially if that player shows hints that it might be ready to pick up some of its marbles and go home. A couple other fundamental factors could be pressuring stocks early on, including a 6% slide in crude prices as summer driving season ends and fears of more coronavirus cases as autumn continues. Whoops, I said it. There were headlines over the weekend with experts predicting an uptick. On the potentially positive side, there's a little merger and acquisition news as General Motors entered a partnership with Nikola, a company with electric and hydrogen car technology. The demand side of the equation. You know what, guys? This article is too long. I'm not going to read the whole thing. Let's just go down. Is there a conclusion here? Lessons learned. Now that everyone's back from a long and hopefully relaxing holiday weekend, it's time to think about lessons from last week's sudden market plunge. One big thing people learned is how quickly momentum can change to the downside. Another is that the sell-off coincided with negative tidings from Capitol Hill on possible stimulus. Whether or not you personally believe another fiscal package is needed, evidently many investors would like to see one. Lesson 3 is that, once again, volatility might have signaled a major market move. The CBOE Volatility Index rose early last week even as stocks rallied, and to some veteran traders that might have indicated some sort of momentum shift ahead. Alright, so I just got a notification on Robinhood, and that was just that some of my dividends got reinvested. Okay, so nothing crazy. I was wondering if maybe I was going to get an alert about how stocks were slowly crashing. You can't see it on screen, but I am going to open up my Robinhood thing. I'm looking at a lot of funds and index funds, and, holy shit, the market is down bigly. Oh, yeah, that's not good. Not good at all for me today. Oh, well. Buy the dip. Let's go ahead and skip to this one. In other news, DeFi is hot, but retail interest nowhere close to the ICO frenzy. So Remember the ICO craze of 2017? DeFi is getting there, but not quite, according to this article. Let's see. DeFi has exploded in 2020, but retail interest in the space remains quite low. If measured by Google search queries, these suggest it may be too early to draw parallels between DeFi's growth and the initial coin offering bubble of the final months of 2017 and early 18. Finally, somebody gets it right, not using the word 2016. Indexed to the peak of search for ICO searches on Google Trends for the word DeFi currently return a value of 18, indicating the retail crowd is as interested in open source finance as they were in ICOs during the latter's boom. The DeFi movement seeks to transform old financial products into trustless and transparent protocols by leveraging decentralized networks. So basically, the gist of this article, I don't need to read the whole thing, is that if you look at Google metrics, DeFi is just not as hot as a word as ICO is this time in 2017 when comparing the 3 years, or the 2 years, 2020 and 2017, because a lot of people are looking to the history of 2017 to see if 2020 is a mimic of that, to see if they want to jump in and hold on to that crypto this year. And speaking of which, let's take a look at the prices officially. Yeah, so Bitcoin is trading under 10K right now. Let's just refresh that to make sure I'm accurate. Now, okay, glad we refreshed. Now it's trading above 10K. Okay. Ethereum above 330. XRP still 23.5 cents. Might be a good time to buy some XRP. Anything else like majorly? Tron's pumping again. Don't ask me why. VeChain is slipping. If anything, I might be grabbing some VeChain, especially if it goes under a penny again. A lot of use cases for that particular crypto. All right, and precious metal news. Things are not looking hot for that market either. Gold is looking to possibly dip below $1,900 for the first time since we've been doing these videos, I think. Silver is doing okay. Looks like it may go under 26. All in all, I see this correction as a sign to buy the dip, but you do you guys. And with that, that'll be it for today. We'll talk again tomorrow. Have a great day.